of LaDuc Trading. I'm Samantha LaDuc, founder of TradeOutLoud.com, and I run a financial research firm. I have a whole trading desk of subject matter experts, and I wanted to just share for those who are not familiar a little bit more of what we do. And recently had the privilege of meeting with a partner company of mine, Spot Gamma. They're very much quant driven because we're, for the most part, my team of 10 is professional option trading focused, and we help clients as well from macro to micro. But they put together such a good little overview of slides. I thought I would just do a quick intro, and then we get right into the substance of trend trading, and particularly this impact that I believe of money going home has on U.S. equity returns. All right, so again, I am macro to micro. If you follow me on Twitter at Samantha LaDuc, I also have a mini-me product on Substack at Samantha LaDuc. But mostly I run night and day with clients in full-time engagement in doing this analysis, education, and trade setups from macro to micro across all time frames and asset classes. So working with both retail and institutional. I do have a very strong team from a classical economist who is very, very focused on more kind of fixed income bonds to very, very focused day traders who work on futures trades and support clients. So we really do meet you wherever you are in your trading journey, from beginner to intermediate to advanced. So I have this, big interest in scanning and synthesizing macro with intermarket, with technical, with fundamental, with quant, and yes, sentiment. And right now we are a sentiment-driven market with a lot of mercurial moves because of headline risk. And so helping clients navigate that is my job. My job is to keep them safe and to help them navigate when we really don't have a directional flow. All right, so this is my backdrop as far as running a live trading room, which is very much focused on market moving news, and then again, chasing directionally one way or the other, what sector, what news is being impacted by the day, and also catching up and doing updates on swing trades as well as durational macro trends and very durable long time trends. And that's where I'm really kind of focusing today, because we've had an uninterrupted market advance for 2 solid years. Since January of 2023, the NASDAQ doubled by the December 2024. We have a new regime in play, which is a new administration, which is very focused on focused on revitalizing our trade with partners to help encourage industrial renaissance, for lack of better words. So really trying to focus more on Main Street than Wall Street, which seems very shocking to most, and most don't believe it because there's a lot of reasons to be suspect. But I'm going to talk about the policies that Treasury Secretary Bessent and the White House administration team are actually putting in play that should be very front and center for trend investors. So macro is definitely the narrative that I use for a backdrop. It's very much the economic policies will dictate price, and that's what we're going to talk about today. And then the micro is the structure of setting up a trade, largely using options, but stock as well, futures, and then being able to manifest some of this this gyration, if you will, in the market short term, while still maintaining a portfolio and protecting that portfolio. I'm not afraid of volatility. I actually work very, very well with it. I joke that it might be because I raised 3 teenagers, but the point is, I think volatility is actually our friend as it relates to option trading as well. So my focus is on supporting every kind of directional move, but using volatility as a tell. And so we're basically putting this into production for clients, and I have a whole team. So I have a really, really strong subject matter expertise, whether it's on a technical approach like Elliott Wave, where Rithika excels, or oil and gas, which is Robert, and really oil and gas is his only thing. So we're talking about subject matter expertise, especially in an administration that's focused on reducing energy prices. That matters. Jeffrey, as I mentioned to you, is classical economics and very focused on the bond market. And we have Archana, who's worked with me for years in my live trading room, along with Mikey, and they're very different in their approach of swing trading versus day trading. Dr. Alex was a client. Many of these people have been with me most of them have all been with me for years and years and years. Dr. Alex was actually a client for years before he just kept sharing phenomenal insights on the healthcare and biopharma space and wanted to offer that up for clients. So now he is a contributor and shares his trades and shares his deep dive analysis on biotech, pharma, the whole healthcare space, especially when viruses start to come, front and center as a market risk as well. So we're very, very blessed that we have this phenomenal, desk. Hans is an options mentor extraordinaire. So he's a solid educational platform for clients that may not be familiar with how to protect portfolio risk, and may not know how to structure some advanced options and manage that with margin and the rest. So he is very front and center in helping them not only build alpha, but also income. So these are James, his operations and marketing, can't do this without him, etc. Nell runs our live chase huddle. So when I close my trading room in the morning, he and Archana take over and answer clients for the duration of the day. So we have, yes, we've got macro guardrails that we put out, but we also, with my focus on sector rotation and my intermarket analysis, I'm really trying to drive lots of trade setups. And we have, of course, not a trade alert service, but trade alerts are provided through portfolios. And we also have lots of great option partner with Spot Gamma tools, which my team uses. So we're well trained in those particular tools to help clients also position and protect. So long story short, this is the service. It is macro to micro, great research firm. Engage with us live, Slack workspace, tons and tons of value. And then you can divide and conquer where you really want to focus your time and what you need, and then you basically engage with us and we get it for you. So this is the long and the short of what I wanted to do just with that review, and hopefully that gives some folks who may not have known that I run a membership service. Okay. But what I want to talk to you about now is a little bit more focused on the market, right? So if you have questions, you can definitely hit me up after. I want to kind of go through first and talk through some of my thoughts around the current administration's policies and how they're kind of making investors anxious. It seems mercurial because it is. And then basically the fact that we have lots and lots of headline risk. Some of you might be very short duration traders and it's choppy. It's choppy. The swing or trend traders that are looking for directional moves are having a harder time until we get through this kind of chop period. So let's talk about why is it so choppy? What the heck is going on? Let's cut out the noise and kind of focus on the signals. And the signals, let me just make sure I've got this screen shared in the right place so you can actually see. Yeah, we do. The signal is very clear to me anyway. So that's what I'm going to share. And that's the balance of trade right now is the end game. So dollar has been falling, and you probably noticed that the dollar crashed a few weeks ago, and it was outsized. It was actually 4 standard deviations. It was a really big deal, not since November of 2022. This was actually a theme of mine even before Trump came in. I had basically summed up that if Trump won, and I expected that he would, that the dollar would actually not be the place that folks would chase, because tariffs would actually help push the dollar down. And I believe very firmly that he would be following through with tariffs. I still believe that. I know that they've been on again, off again, and I know it's a negotiating tactic. Many believe that, he's just trying to get the tariffs against us, the reciprocal tariffs, basically, those that are already in play, removed. But a lot of countries aren't going to do that. They're not going to, they might, some, but the point is, I think he's really, really going to focus and follow through in getting tariffs. So one of my major themes, even before he was elected, is that the dollar actually would fall. And I actually talked about this in a prior little chat here with folks, which was called the Trump trade. and talked about it. This was last year that Trump would win. And then specifically, this was what did I see happening? And this was, oh goodness, what was the date on this one? October. So even before the election, right? Okay, so this was the Trump macro trade. And I was in kind of talking about this specifically before Bessent was even chosen as Treasury Secretary. And that would be that peace would kind of force, I should say, Trump would kind of force an armistice between Russia and Ukraine. And that would lead to less war spending, less printing of dollars, less fiscal strain. All of that would be seen as beneficial, and it would help support our bond market. So, but it would also help lower an overvalued dollar. And there'd be less demand for, U.S. defense contractors, et cetera, et cetera. I talked about the euro, falling inflation, et cetera, et cetera. Price leads to falling yields, which results in more normalization of rate cuts. This is net bullish for U.S. bonds. So this is what I literally talked about here back in October in kind of the Trump macro trade. And a lot of this is still coming into view. So that's the first thing, that the kind of the Trump trade is at peace. And how does this have to do with the dollar? And in particular, demand for dollar would be falling, not just the BRICS, but I showed before, then this is over and over again, that I really saw that the demand for dollar would be falling. Talked about all these kind of levels here of where we actually start to de-dollarize. And that's not a bad thing as it relates to U.S. Exporters. It's not good for U.S. importers. And that would be part of the theme. So all of this that I talked about back in October, and then of course, Trump won. And we're still looking at the early, stages of a forced armistice between between Ukraine and Russia. But the long and the short of it is they're still in play, these major themes. And so was my recession risk pulled forward into the end part of 2025. So I talked about that then. And that was basically now a theme. And you know that folks are, ratcheting down their year-end estimates as well, just so you know, as it relates to this type of thing. And this is not even current, but Barclays, for example, instead of 6,600 as their year-end price target, they have now revised it down to 5,900. So more and more firms, Yardeni Research, and yes, a lot of these houses are very bullish, and they're, it's recency bias. We had such a good 2024. Why wouldn't we have 2025, et cetera, et cetera? But the point is, many of these houses keep lowering their price targets. Yardeni was no recession in sight. Now he's 50% recession in sight. It goes on, right? He was 7,000 hat. Now he's 6,400 hat. And that's still way higher than where we're at right now. The point is their earnings are starting to get revised lower. This is 13 weeks in a row that earnings have been revised lower. Guidance Q4 was good for earnings for companies, but their guidance for 2025 was not. So long story short, we've got this re-rating of companies. We've got this re-rating of S&P returns because of the backdrop of macro, and the dollar going down is forcing this kind of revisiting of, wait a minute, what is the Trump trade? So I want to kind of go over that. What the dollar going down means is money goes home. And this is a little snapshot that I grabbed just yesterday, right? Where market returns per nation. This is another example. America, US is down, 2-3%. But China is up 19%. Even Japan is up. Germany's up 18%. Poland 35%. Every chase, abroad is in this kind of motion of US has tariffs, and it's less sure what is going to happen with their congressional spending, what's going to happen with tariffs, what's going to happen with the stock market, with AI. China has definitely come in on Inauguration Day, January 20th, and revealed DeepSeek. And that was a deep six of the semi-space. So we had a very big repricing immediately on the recognition that China basically does have AI tech dominance, and it's not just America's exceptionalism. They actually have a lot of technology, not just AI, science, energy. And the US investors weren't really looking at that before, and now they're looking at that. So the combination of the dollar falling, the returns abroad versus US is part of the plan. I don't think that this is actually a feature, not a bug. So in kind of like reviewing the whole idea of US, I'm not even going to talk about US exceptionalism because that's not my goal here, of US equity returns being so strong. It's that this was because we had policy intervention in the House very strongly under the past administration. So the combination of White House and Treasury head Yellen and Powell, who's still head of Fed, they were very coordinated to make sure that anytime equities or bonds looked like they were going to fall off a cliff, they came in and did intervention. So lots of stimulus, lots of monetary easing, and the result was a doubling of NASDAQ from the January 2023 low to the December high, a doubling of NASDAQ. That's not going to happen this year, right? I hope that you can kind of think about this review of why I think that's not going to happen. And I think this is the number one reason. Many really don't mind that we have a trade deficit because, can I bring this higher? I cannot. Okay. Many don't care because we've had such a fabulous time of just printing and buying from abroad. But that's not what the Trump administration wants, right? We are not in a good situation. We have a deficit, not a surplus like other countries. We do not have a heavy savings allocation like they do in China, for example, or consumption-focused economy, which, by the way, China's been working on for the past few years to become less dependent on the US, to become less dependent on the petrodollar. If these terms are a little bit, unfamiliar with you, well, I'm happy to help, kind of educate a little bit. But my assumption is that many of you probably have a good working of this, and I'm just trying to give you my perspective of how this blends together. And one of the big reasons why I think that a lot of the US didn't care about the fact that we were doing so much buying from China and abroad is because if you look at this chart, you can see that the US balance of trade inverted matches beautifully with the net worth of the top 1% as a share of GDP. It's a beautiful fractal. Okay, if you're in the 1%, you don't care that we've printed and basically socialized losses because the result is a deflation of event in US employment wages. And this is really where, not deflation, inflation. In other words, we are not competitive abroad, right? So that's why US companies have gone abroad. It makes sense. Path of least resistance. Okay. But now that's what the administration wants to reverse, right? So wants to force the manufacturing stateside and force buying consumption by consumers and corporations of US stateside manufacturers. And all of the trade tariffs and the trade wars and such is all about returning this industrial renaissance. But it's not just so easy. At the same time, the tax cuts, the deregulation, that is to help offset the hit from tariffs and trade wars. This will be a bumpy ride. And Treasury Secretary Bessent is out front and center with Stephen Mirren, economic advisor, with the whole Lutnick, e-commerce, Secretary of Commerce, reminding over and over and over again that there will be this detox period, exact words, right? But in time, this revitalization of US economy, not based on policy interference like the prior administration, and administrations, I might add, but more of a focus on we can do it. We can do it. We don't need to be reliant on other countries to produce these goods and take US jobs. So this is really, really a guided light, I think, for the Trump administration. The result of this, however, and this is very important, is that the dollar needs to fall. This is critical. So what is the Trump, administration going to do about this, since our current very high U.S. rates relative and inflation make the terms of trades very ugly, and we have U.S. dollar as reserve currency? That makes it really hard to reverse this trade deficit and bring it higher, let alone even think about surplus. This could take years, right? So this is what I have kind of written about repeatedly, is that this de-dollarization that you see is a slow process, BRICS and such, and countries trading amongst themselves, not in dollars. Also, they're settling in gold, right? Not the petrodollars. This is part of the plan. This is part of the plan, because in order to have this industrial renaissance in the U.S., they must, repeat, they must have the dollar, the demand for dollars must fall, full stop. Otherwise, the potential trouble, believe me, in devaluations and other things really can hurt. And we don't want that. They have a plan. I somehow figured that out early. And everything that I've seen as far as the evidence of what they are showing completely confirms this view, in my humble opinion. We know the U.S. production has become less and less competitive. We know that. So the solution, long story short, is that this loss of competitiveness from U.S. manufacturers means the U.S. dollar has to fall, full stop. And they think that's going to save U.S. manufacturers. The problem is that's not all. Yields also have to fall. And that's the really big missing picture that I don't see the administration fixing yet. I think they're on their course for sure in trade negotiations, trade tariffs, all of that, talking down the dollar, all of that, de-dollarization, all of that. But very hard to manifest wishful thinking when it comes to Treasury Secretary Bessent, who wants the dollar down, but also wants yields and energy prices lower. I'm not going to focus on energy prices right now. I personally am bearish energy, oil from last April. So this is right now range bound, but we haven't fallen, and we likely will now that the administration really has come right out there. Navarro came out and said, I want $50 crude, not 70. Well, U.S. oil and gas drillers might have a very hard time with that. That triggers kind of an oil industry recession like we had from 2014 to 2016. But the fact is, that's not the focus right now, because they can't do everything at once or else the market will just throw up. So this manifestation of lower dollar, lower yields, and lower energy costs will happen over time under this regime, short of war and other kind of disruptors. So let's talk about, as a result of this, is part of a coordinated effort, I believe. Good, bad, or indifferent, that's not the point. I'm assessing what the macro is happening because it's going to impact equity returns. Big picture, trends are going to be very hard pressed to move higher under this administration. And that's a feature, not a bug. This is not a criticism of the new regime. This is a feature of the new regime. They need to get foreign investors. This is what they want to do. I'm not saying this is what they should do. They want foreign investors to go home. They've made it very clear. Their executive orders are very clear. Bessent is talking about having his Treasury Department draw up paperwork to prevent even U.S. investors from investing abroad. Like, there are some things in the works here that are absolutely creating an isolationist type of country when it comes to trade, but also when it comes to equity returns, equity investment. So let's just kind of go through this and hear me out and hit me up if you have questions when I get done this. But I want to get through this first because it's a line of thinking from dollar is falling to Bessent really wants to get this through to everybody. And I mean, he is constantly on TV interviews. Have you noticed? So it's part of a coordinated effort with Trump, with Secretary of Commerce Lutnick. Oops, sorry, I don't want to do that. Hold on. I remember I'm on a working draft, as well as all that government cost cutting by Musk-led Doge. By the way, they've gotten kind of quiet lately. Part of that is because they're embroiled in lawsuits, or I should say a judicial action to prevent some of these orders from following through, which is a delay. They probably will still be able to push through. But the point is, It's very hard to fire people, government contractors, but they're going to try. And it's very hard to cut expense and when it's already been allocated and distributed, and judges are coming in and getting involved in this, and that's the mess. That's the noise. But the signal is very clear that the coordination of DOGE in cutting waste, fraud, abuse, with Secretary Lutnick going on the shows and talking about, in a salesy kind of way, how they have to do this tax, tariff and trade war in order to make America great again. Well, we're going to get to that. But it's mostly Secretary Bessent who has a very, very clear line over and over and over again. And it's very clear that he is very focused on the balance of trade. So the balance of trade that I showed you when I started with deficits, right? And how falling dollar and tariffs and de-dollarization, all of that is going to benefit U.S. exporters, not importers, and how it will result in falling dollar. And that also means we are going to have equities re-rated lower. There will not be government expansion. It'll be contraction. So you got to deal with that. You can't ignore that. You can't. All right. So central to that whole agenda, by the way, isn't just the overvalued dollar has to fall, but it has to fall by a lot. We're not even to 100 yet. I'm not talking, 100. I'm talking 90, 80. So that's what I think is not priced in. And it's really hard to model for a lot of economists. I play one on TV. But the point is, I think a lot of folks are having a hard time really getting their arms around how much the dollar has to fall in order for U.S. exporters to have a real fighting chance at competing abroad and to incentivize and have them invest in U.S. production. So this is needed in order to force U.S. consumers to spend locally, not globally. That's the agenda. This is really the agenda. And fighting it is just going to be futile. We'll see how far they get with their other agenda, which is reining in spending, U.S. government spending. But for right now, tariffs are definitely part and parcel to this whole investment and spending regime change. And that's why this market is really going nowhere fast in the U.S. So, and also bond market. So if you look, stocks and bonds are kind of neck and neck with nothing returns year to date. They're a little bit under, but it doesn't matter. They're not going anywhere for the past 4 months. And I think that's also a feature, not a bug. So you've got a situation where Trump needs time to negotiate tariffs. You also have a situation with 24 trillion in market value of global merchandise trade with allies and enemies alike. Seriously. So that's going to require some measured approach, but unfortunately, Trump is not really known for his measured approach. So that's the criticism that, you can have for sure. But the bigger picture is still, I think, crystal clear. They really do want to balance trade. And this is why it's very hard to trade in this environment because of escalation tactics that he comes out on a Sunday evening, and I call it jump risk. Comes out on a Sunday evening and doesn't say, I'm just kidding, but he definitely says, I'm going to lighten the load on tariffs. And then all of a sudden, boom, a market, gaps up on a Monday and runs 100 points for 100 SPX points. And then it starts to roll over again. And we fill that gap from the Friday high because he after hours says, yep, auto tariffs of 25%. I've just made them permanent. So this is the mercurial market that right now is landmine after landmine. So I like to pull out, look at the macro, I look at the macro trends, like to position for stocks, big picture that are recession proof. Anyway, we're going to get to that. But the point is, this is very much a difficult environment for corporations to even price in. They don't know how to price in war because we don't have any yet. We're trying to pull out or force an armistice in one region and potentially escalate in another with Iran, but they can't price that in. Very hard to price in tariffs because they haven't really been implemented. Some threatened, some delayed, some doesn't matter. Point is, they're having a tough time pricing any of this stuff in, but they are light on guidance, right? They're worried about guidance. So we're going to get a chance in a few weeks to look at earnings, but I don't think it's going to be any different. Losers, I should say, those who miss will be punished. Those who beat will not be rewarded so heavily, and most will guide conservatively for 2025. Full stop. In the meantime, we're going nowhere fast. We have big trade that's at risk and lots of tariffs that haven't even been rolled out yet. So, brace for impact kind of thing. And then, of course, we have some countries that are retaliating. I wrote a huge piece on China, which was about their gift to President Trump on Inauguration Day, January 20th. And it was really about telling them, reminding them strongly not to tariff, not to engage in a trade war with China. It would not be to our benefit. So they launched DeepSeek in full awareness that it was going to cut out the AI superiority and the AI capex that had been driving the stock returns for the Mag 7, Nvidia, Microsoft, Amazon, Google, you got the list. So then they layered on, oh, it's not just, Baba also has Quen, and there's another one for a fraction of the cost, and superior products that are continuing to get rolled out from China, both in AI as well as other science and energy related fields. So they already have a stranglehold, if you will, on lots of manufacturing. So this was just another reminder to Trump that really play nice, or we're going to take away your AI tech dominance as well. And the market hasn't priced that in. I mean, despite what's happened in the market in the past few months since that gift, analysts have not re-rated Nvidia, not one sell rating. Very dangerous. Investors do not know what's going to hit them. So I would say the point is company earnings do not know how to price in tariffs, so money goes home while the Trump admin is trying to decide who to punish and who to reward. And then getting to the market sell-off that we had very quickly, very quick order. Luckily, I run a live trading room, and I also have tools where I can see internal breadth breakdown, net selling, net buying. And I warned clients on Tuesday, the 18th, and then again on the 19th, before we rolled over very strongly on the 21st, which was Friday. And then we dropped 10% in SPX in very short order, and we dropped 15% in NASDAQ, very short order. It was a fabulous short for us. But it was also aided and abetted, and most people don't know this, by an executive order that Trump posted on Friday night, the 21st, that obviously the market smelled, or those on the end did know, where there was a very big focus on U.S. investment abroad being a no-no. So I talked about that. It was basically do not invest in China businesses, China stocks, and again, enforcement is another matter altogether. But it is still talking the dollar down, talking yields down, talking U.S. investment abroad down. Then comes the action to make sure that these agendas actually follow through. So you got to be careful as an investor to navigate all of this. So I was able to, spot that early. But the point is, this whole market sell-off, in my humble opinion, and I've done interview after interview on this, is that this is a feature, not a bug. So I'm listening to the warnings of Secretary Bessent. I think we all should. And I think many investors believe Trump is bluffing on tariffs and they don't want to sell. And he's blustering on and on and on about, other countries' tariffs getting removed. That'd be wonderful if that happens. Oh my God, we would have such a market advance. Boom, we're off to the races. But what are the chances? What are Vegas odds? I jokingly, discuss. And then there are those who believe the master plan is to crash the economy. No, Trump doesn't want to crash the economy. No. But if they cannot get yields down, they will pull forward recession risk, which will pull U.S. Treasury yields down. And that, as you know, triggers volatility, which then triggers equity repricing. So it's kind of to be a little aware of this, I think, is very beneficial. Anyway, that would be awesome if other countries just remove their tariffs. But what are Vegas odds? Kind of think about that. And then those who think the economy is going to crash, either because of incompetence, which is not my baseline, I'm not making that argument. I'm saying I don't think they want the economy to crash. I think they actually want to force foreign investment out of the U.S. stock market, out of real estate, farmlands, businesses. And that by nature will cause equities to get repriced lower. You just think about it. Okay. So this is it. And very important, Every single time that the market has sold off, we've had policy intervention by Fed, Powell, Treasury Yellen, and the White House. Every single time. Remember the bank bailout of 2023 in March? They came out on a Sunday evening and said, we will backstop every bank, not just Silicon Valley. We will backstop every deposit of every U.S. bank account. Come on. No, it's policy intervention. They come in even if they can't do it, and they make sure that the confidence in the banking system, the confidence in the White House, the Treasury, the Fed, and the U.S. Equity market is secure. Now, Bessent has come out and said, nope, we're not going to policy intervene. We've already had a lot of that. We've already had this QE, unending QE, which does nothing, but short-term gain for long-term pain. We're going to detox. So it's kind of time to pay attention to the fact that there isn't that put anymore. There's lots of talk when we do get a little bit too rambunctious here in selling, but there isn't any actual policy intervention that's been promised. So this is it. We've got money going home. I'm going over that over and over again, and then I'm going to just say again, it's catching on. So this theme is that now that they've started selling, right? Deutsche Bank comes out and says that there could easily be, $1 trillion of foreign selling. This is way bigger than the corporate demand. Referring to corporate demand is corporate buyback. So the U.S. has a very robust method of financializing our equity returns. Tons and tons and tons of corporate buybacks have helped Apple, stay moving higher, even if they have not returned higher net interest margin, net margin, or revenue growth to equal their valuation. But buybacks have helped. I can go on and on and on. You know how this works, most of you. So the point is, now banks are coming in saying, actually, there's a lot to sell. More importantly, there's 25%. This is my little blip over here. 25% in USD value of foreign ownership in equities. So Trump and Bessent want that to lower. They want that to fall. And that means equity returns will be very hard pressed to move higher with that elephant in the room, that whale in the room, especially when they're chasing returns abroad, China included, or China especially, or Germany doing their fiscal spending at, what do they call it, defense QE. All right, so you're going to have a tough time navigating, I think, with knowing where money is flowing, but not a tough time in seeing the money rotate out of the market. Dollar is falling, and that's the political goal. All right, so I jokingly said Trump is encouraging them, meaning foreign interests in our U.S. stock market, to sell, and they are. And this is like make the stock market uninvestable again to foreign investors. That's quietly the new mantra. So this is my feeling that this will be a theme for the foreseeable future. The dollar falls in time that will support the U.S. economic recovery. And I'm talking about the recovery, meaning government shrinks, U.S. private sector has to pick that up, right? Or else GDP growth contracts. Well, we're not in a situation right now to pick that up. All the firings of government employees and then the related government contractors and all the contracts, all the money that's generated in the economy is not immediately replaceable by the private sector without more stimulus, right? Continuation of the tax cuts, deregulation, but also this forced behavior to invest in plants and people, not the stock market. The stock market is where you go to get your hit of easy returns. Investing in capex and projects and people, things over paper is harder. But that's what we need to do if we're really going to be great again. And I think that's the agenda. So what's the trade? Basically, this is my summation. Basically, this is the policy endgame of foreign interests demanding fewer dollars, check, of exiting positions in U.S. equity, bond, and real estate markets. I think that's the goal. At the same time, falling U.S. dollar and rising tariffs, which I believe are going to continue, on U.S. imports will impact a rate spread differential. It's just a fancy way of saying we're going to have a pull down in yields And that is to help U.S. companies and households refinance. Remember, they came in 5 years ago near ZIRP, zero interest rate, and now we've got 4.5, higher, obviously, for most. But the point is, you've got a situation where this will help supposedly bring down yields and help with refinancing and build back in reverse all the 40 years of outsourcing. Okay, so that's the goal. If this works, and there's a big if below, but if this works, it's bad for U.S. importers. That's your trade. It's good for U.S. exporters. It is definitely a situation with a falling dollar. And I don't just mean to 100 for Dixie. I'm talking much lower. And that also means money goes home, equities get re-rated lower. There is not your natural buyer of liquidity in the market, which is that foreign component. And then, of course, bonds are the big question mark. Besant, Musk, Trump, everybody says don't short bonds. But the reality is you can short bonds if the government spending does not get reduced. And right now, that's the biggest problem to this whole agenda that I see. Blaring, neon light. Oh my God. It isn't that we have a deficit, it's that the government spending is out of control and it just continues to grow. So case in point, in fact, I just tweeted this. Where the heck was this real quick? Bond raiders will be back with a vengeance. CBO, federal debt held by the public, boosted by sustained deficits, will grow far beyond any previously recorded level over the next 30 years. Literally, just before, just tweeted that. All right, so why is that a problem? We'll just print more. Well, we're not at that point anymore. We can't just print more and get away with it without inflation. That has been proven. We can't just print more and get away with it without inflation and stagflation, which is shrinking economic growth and higher prices, especially as the interest, follow me, as the interest on the debt starts to become unwieldy against what we receive in U.S. government receipts. Follow. Okay, so here's what we get. Write down. What's the risk? What's the risk? The risk is that even though falling dollar is going to happen, it's very hard to control with falling yields. So you get two main ways to bring U.S. Treasury yields lower. This is all part of that, remember, three-prong approach that Besant keeps talking about. One is make Congress stop spending, which they haven't done, or reduce spending ASAP, which they haven't done. So this is going to force a growth scare because they haven't done the spending cuts. We're going to instead have this growth scare, and the growth scare can trigger a deflation impulse, which pulls recession risk forward. So that's the other lever they have to pull. And bond traders will be punished, not bond traders, I'm sorry. Bonds will be punished if they don't get control of this fiscal spending. So they'll be fine. They'll be fine. Bond traders will not punish a government that is cutting expenses, but that's not what's happening right now. So the fastest way to get yields on U.S. debt down is to push the U.S. into recession if there is no fiscal restructuring. And right now, Doge is not enough. So it would really help. It would definitely help because we get the debt ceiling showdown in August, which, by the way, the CBO, Congressional Budget Office, has just come out yesterday, in fact, and said, well, you know what? It might not be August. We're probably going to hit our limit in May or June. There's a high potential, which is another reason why the market's in shake and bake. So the problem is that there are many problems. The U.S. Congress is still spending, and I was going to, I've got a link in here, but somehow it didn't make it in. Anyway, this is the gist of it. This is the gist of it. You know, the continuation, the reconciliation bill that just got passed, right? And they're now, the GOP is trying to figure out how to get the debt ceiling raised with the tax cuts. That's not the issue. It's the spending. So the spending is really, really, really important. And this bill, which Representative Thomas Massie, who's really a libertarian thinking Republican, and he votes against all this additional spending that we can't afford, which I love. And he says that continuing resolution bill that just passed continues the Biden, Schumer, Johnson 2024 spending agenda for the next 9 months of the presidency. So literally for the next 9 months, yields won't go lower if you have this type of backdrop. And more importantly, that debt interest is critical. So there's rising debt interest against U.S. government receipts and that is just a toxic backdrop for bonds and our monetary system. So the House approved this huge public debt extension with interest expense. It comes into 125% of GDP and over the next 10 years from last year. And that is right now, by the way, 117% under current law. 6.8% of GDP deficit compared to 5.8% under current law. Translation, they're going in the wrong direction. That's all I want to say. So watch that top number. Watch that top number. Because Luke Groman, also Jeffrey Fouvre, who I work with, who's the classical economist, brilliant, have already warned that interest expense must not exceed 130% of government receipts, or we risk a currency, a bond, an equity correction of size, not little ones, big ones. So, right now, it's quiet. We're going sideways. We're topping, but it's slow. Now, the U.S. interest expense that I'm kind of harping on, and Luke Groman has already kind of identified that we're really already there. So we're already at 130% of government receipts. That's not a good place to be. We need to get spending cuts. We need to get interest expense down, full stop. That would help the US dollar fall, yields fall, and this refinancing and this exporting boom. We will not get it without it. Full stop. So this is where we're at right now. You hear all the detox language by percent, and that is because a U.S. trade deficit requires lower U.S. dollar and this detox period of slowing growth. How does an economy keep going? Through contraction, through expansion, not contraction. And this is also something they want to slow down, which is inflation, and that would put pressure on yields. Unfortunately, spending is the opposite. Also, Jeffrey reminds, a true restoration of financial stability is always spending cuts. You can find Jeffrey on our website, LaDucTrading.com, under my team. He is part of our Edge offering, working with more really sophisticated money managers and hedge funds. But I'll tell you, he shares his insights with me, from which I glean amazing value. And then I can kind of put it in my own language and share it with clients, which is an example of this write-up that I did in advance of a talk with Charles Payne today, but it's also for clients. And this is something that we've been on for a while. So even if taxes are lowered and the deficit increases, that's not the big problem. It has to be about spending cuts. So if you see spending cuts come in, then you're going to be much more bullish as an investor. It's critical. The nightmare is when you don't do anything about this, any fiscal consolidation, fiscal restructuring, however you want to put it, and we kind of live in this quasi-fiscal. I won't get into that, but the point is we're kind of still in danger of being emerging market-like and having real currency or sovereign debt risk, both currency and sovereign debt risk. So that's it. We have to get away from this type of dependence. And that's basically the UK today. So they're going to default before we do. There's that. And default's the wrong word, but they're going to suffer before we do. We also have the reserve currency, but we have to really, really think about falling dollar, falling yields, falling energy prices. Short term, it is a headwind to equities. Longer term, it's necessary for financial stabilization. So long story short, this is the summary. Okay, after kind of reviewing my view of the macro from a policy administration standpoint, Trump, Bessent, Lutnick, and others, reversing our massive U.S. trade deficit is job number one, and it will require lower dollar and a detox period of slowing growth. That will lower equities, just kind of by default. But hopefully yields. The hopefully is the part that's kind of tough, right? Because I've already explained yields are not falling. And the reasons why they're staying sticky is because of spending. Okay, so will it be enough, however, their policy agenda, as they roll it out, will it be enough to stimulate U.S. manufacturing, savings, and consumption? Because that's ultimately where they're trying to go. Even if investors are hopeful this is the beginning of a U.S. industrial renaissance, it will take time. And Congress raising spending negates the deflation impulse to lowering yields. Remember, lowering yields is disinflation. higher yields, inflation. Think of that. Unless recession risk is pulled forward and then we get a deflation impulse, boom, just like that. Yields fall, oil falls, right? Because it takes a hit on both global credit demand falls with oil, global oil demand falls. Anyway, it's a deflationary impulse. And that's usually when they come in and do quantitative easing and basically stimulate the market again. But that would have the negative effect of having an inflationary impulse. We don't want that again. So Main Street's already suffering, right? Main Street has had this 30% inflation rate, not 3%. Fed measures it on the rate of change. Wall Street measures it on the rate of change. Main Street knows that pre-COVID to now, compounded inflation is up 30%. It's very, very different. This is a way for recovering some of that inflation impulse, but it could very well include a recession risk that is pulled forward, and that means market gets repriced, jobless, employment is definitely going to get, employment rate's definitely going to, I shouldn't say employment rate's going to rise, but you know what I'm talking about. So unless even as many adjust their predictions and projections on rising inflation, rising employment, I'm really focused on the rising risk to U.S. equity and bondholders. So that is the gist of a summary on my view that trade balance is really, really important, and kind of put in perspective all this stuff around dollar and yields and where we're going with equity returns. Right now, they're going abroad. And big picture, when you're focusing on kind of trends, look at those who are exporting as being well positioned versus those who are importing a lot of goods. They're not going to be in a great position. And then, of course, as money goes home, how are you protecting your trend long investments? And as trade wars flare up, how are you protecting your Mag 7 holdings, et cetera, et cetera. So I hope that does a quick review. Didn't mean to have this Zoom camera right in my face like that. But if you have any quick questions, let me know. Otherwise, thank you for listening to the long rant, but I thought it might be perspective and a little bit different than your usual technical analysis, which I do every day in a live trading room. But to actually see your questions, I have to bring this up here because, yeah, blind as a bat. What do you got? What do you got? What do you got? All right, so just real quick, I'll go through this until you cut me off there, David. Yes, that's right. You saw me on the show that was really quick. Like you can't do anything in 5 minutes. Not a thing. Okay, so that's the roll. I was on a roll that's all macro. We have a service economy, not manufacturing. That's what they're trying to change. Deregulation, yes, we need much more of it. I totally agree. Deregulation on the health side, it depends. But yes, like I said, I have benefit from Dr. Alex, who is monitoring that, and he's a practicing surgeon, so he sees it firsthand, and he's been a hospital administrator, so he really knows it. Supply, good for everyone except those who fear competition. Privatized utilities have never worked anywhere in history for any country. Privatized utilities? I don't think I talked about that, or privatized health. Okay, well, that's your opinion. You're welcome to it. Okay, we get to enjoy free AI benefits, which is fabulous. Oh my goodness, yes, Main Street is definitely, Wall Street will impact Main Street as it relates to the wealth effect. Huge, absolutely huge. In other words, it means be savvy about what you hold, know what you own. How's that? And this is true. This is why money is flowing into Latin America, Europe, even Japan, as yields rise there, but especially China. This is not your typical rotation, 100%. China exported deflation, 20 years, people produce goods in both terms of construction and quality. They have become better with quality. China, but can be export position through having. They've actually done, it isn't just about the quality. They've actually transitioned their economy so that they're more they're self-sufficient. So they drove this decoupling from rest of world, specifically the US. So they're not trading as much in dollars, right? They're settling in gold. They're settling directly with other countries, and they have gone through the pain, a lot of pain in restructuring their consumption focused economy. And they're, by the way, their citizens are huge savers. We're not. So they already have transitioned also away from oil into EV. Electrification is huge. It's a mandate, and that is a huge stimulus for their population. Oh, thank you for that comment. Would the world want value over price enough to be part of the formula? Robotics is going to be part of it. AI is going to be part of it. That's true. I agree. Pissing off allies is not a great way to move, in a war-driven kind of way. But we don't have to. We can hope that that's going to be mitigated in some time. I think that's right now a strategy more so than an end game. All right. Thank you for the feedback. I know it's very, very different. I definitely want to focus on the spending because that is the one thing they have not gotten control of. But as far as the Doge and the tax cuts and the deregulation and the falling dollar, this is part of the plan. And equities falling is going to be part of the pain of this detox. Full stop. Hopefully, I've shown you why. Because money's going home, period. Now, the big, 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 big nut to crack is still spending. They have not cracked in any way, shape, or form that very, very hairy problem. That's a big, big problem. What? Oh my God, they're not political. First of all, I'm a registered independent for anybody who cares. You have your own opinions. I'm very much focused on trying to figure out what they're doing and why and how it's going to impact my clients and their wealth. So that's all I got to say about that. I wish you all a great afternoon. Thank you, Anka and David, for the time. Cheers.
All right. All right. Thanks, Sam. All right. Thank you to Samantha LaDuc of LaDuc Trading. She closed out this event for us. All right. So I had some technical issues today with my internet connection. So a couple of the recordings might not be available immediately, but I'm going to post this link. Uh, okay. Um, all right. So, you all right. So I just posted the recording. Um, that that page will become the recording for today, as soon as I can get everything processed. Also, I'll give you this link. That page I just posted will become uh, that will become the archive for the entire event. It'll have a list of individually all of the recordings from the whole event. So you can bookmark that and review them at any time. In case you didn't hear this earlier, or are new to Time and Research, I've been hosting events for over 10 years now, and uh, all of the archives become permanently placed on the site and the Time and Research YouTube, and you can review those at any time. So, um, if you want the direct link to YouTube there. Also, there's Substack. You can get the updates that way as well if you prefer. Tim says you did a great job with a strong line of speakers. Thank you for the efforts to do this. Uh, yeah, you're welcome. I hope everyone got a lot out of this. Yeah, we spend months putting these together, and so it's great to hear that uh, how much people are enjoying these. So I got a couple free reports for you to check out too. If you have not seen these yet, best tools for or best yeah trading tools for 2025, an ebook that I helped put together, and also a um, top stocks uh, report that I was a contributor to that you might find interesting. Um, so if you have any feedback about the event or questions or anything like that, you can simply reply to any timing research email that comes directly to me. Um, or um, there is a contact page on the website that you can use as well. So let's see, one more. If you want to go ahead and put these on your calendar, the next two big events are our next Analyze Your Trade event. And if you haven't seen that series before, basically I get a bunch of analysts together and they have half-hour segments where they share their screen and show you their live charts, what they use every day, and you can give them symbols for them to look at, and they analyze your trades live or your trade ideas live in the event. So that'll be April 15th. We're going to do that as a single day event. I'm going to try to have 20 different analysts throughout the day. So uh, that'll be a long day, but be exciting. That's always fun to do. And then the next Synergy Trader event will be May 13th, 14th, and 15th. That'll be Pillars of a Profitable Trading Plan. Um, so, yeah, so for that one, I'm going to have 30 different guests over 3 days, and I'm going to ask each of them to select a process or piece or aspect of their trading plan and explain that to you in detail. So that should be fun. That's kind of a new theme that we're going to try. All right, so that's it for this event. The seventh annual Women Teach Trading and Investing event on TimingResearch.com. And I just want to thank a couple of people again. Thank you to Anka Metcalf of TradeOutLoud. She's been my partner on this series. Um, you know, so she's been a great partner. Also want to thank our co-sponsors for this one, OptionProfessor.com and MadHedgeFundTrader.com. So, all right. Thanks, everyone.